Another month, another load of inflation data for the UK, and the headline number that you'll see is the UK inflation slowing to 6.7%, down from a whopping 6.8% just a month ago.
It was 6.8% in July. Okay, so what you're talking about there is just the rate at which prices rise over the course of a year. This time, 6.7%. Wow.
Now, what this means is that on average, from just 12 months ago, most things that you buy are now 6.7% more expensive than they were just 12 months ago. Now, on a positive note, if there is one, this number was slightly below what some people had expected, but it's still not exactly something to celebrate because it doesn't mean that prices are heading lower, it's just that the rate of them going up is slowing a tiny bit. Remember that if you do want to pop the champagne to celebrate lower prices, then technically what you'd need would be deflation. That's when costs actually go down. What we have now is a bit of disinflation. That's when prices are still going up, but they're going up at a slower rate. Now, until eggs and olive oil fall down to a price from where they are now, calm yourselves down because there's more to look at. And on prices, here's what's having some of the biggest effects. Here's the data on screen from the latest ONS report, and you can see the three different measures that they track. You have CPI, CPIH, and then OOH, which stands for Consumer Price Index including housing, and then owner-occupier housing broken out. Now, one thing you'll notice recently is that the owner-occupying housing costs have been starting to rise a lot more, and this makes up a large chunk of the overall CPIH number that you can see in the darker blue colour here. The kinds of things that make up an owner-occupier cost are rent or mortgage payments, council tax, and general costs of running a home. And it's no surprise that these are trending upwards with the rises in interest rates that are working their way through the market at the moment. You see, in reaction to these inflation numbers, the Bank of England will make a decision tomorrow about what to do with interest rates. And we're expected to see them move from 5.25% to 5.5%. So a 25 basis point increase takes them to the highest level that we've seen for a very long time. What this does is a number of things. Now, firstly, it means that borrowing money becomes more expensive, whether that's for personal loans, credit cards, or mortgages. And then secondly, don't forget that it improves the rate that savers can get on their money. Now, both of these things working together should squeeze the amount of money flowing around in the economy, so the prices of goods and services fall, as less money chasing after the same amount of stuff should move prices lower. Economics 101, good old supply and demand. However, one of the biggest factors in this is mortgages, and with mortgages in the UK, you don't feel the effects of interest rate rises unless you're about to remortgage or you're about to buy a property for the first time. Now, typically, as many of you will know, most mortgages in the UK are on fixed deals which either run for 2, 3, or maybe 5 years. So you don't get to experience any large jumps in interest rates until you have to get yourself on a new deal. And unfortunately, we're heading into a mortgage time bomb over the next 18 months, as I've covered before in this channel, as hundreds of thousands of people with pretty low interest rates on their mortgages are going to be moving from something around maybe 2% to something closer like 6% if they're lucky. And this means that most people are going to have to find something like £200 to £300 a month extra just to pay for their mortgage. How this plays out, we'll have to wait and see, but I'll probably go into more depth on a later video, as it really does all depend on whether or not interest rates get brought back down in response to the next few months' worth of inflation data. Now, back on the current data, as much as some people might want to say that it's good news and take credit for inflation coming down, there's still a lot to be worried about. Now, here's the overall picture broken down into the different categories, showing how, compared to last month, prices have changed. The biggest contributors to the slowing rates are food, restaurants and hotels, and then recreation and furniture at a joint third. And although that's a positive sign to see the drops, here's a reminder as to what food prices have done over the last 12 months, just from some of the most popular items. Sugar tops the charts at a price change of more than 55%, followed then by olive oil, and then multiple products all increasing more than 20%, like yogurt, pork, and eggs. Basically, anything you like eating for fun has gone up way above the average rate of inflation. And this is a big reminder that we all experience the rate of inflation differently, as it all depends on how much of your income is taken up by things like the food shop. Now, sure, some of the things are outside of our control, like olive oil, for example. This isn't some huge demand spike because we now all want to eat a Mediterranean diet. But the other items all get squeezed by the biggest culprit of all, and that's energy costs. Now, take motor fuels as a category here, and this explains a lot of what we've seen. Now, compared to 12 months ago, motor fuels have actually come down 16.4% on an annual basis. But rather than keep falling, we all would have seen the price of petrol and diesel go up at the pumps over the last couple of weeks. And if we look at the global markets, we can see that the price of oil is now at a all-time high for the year, up more than 16%. And if we look back further, we're now getting closer to some all-time highs with no signs of it stopping. Now, the reason this needs to be talked about is that oil isn't just about what you pay to fill your car up. It's a cost in almost everything you buy, because somewhere along the line, everything needs to be transported by trucks thirsty for diesel, crops that need to be harvested, and animals that need to be fed. And all of this needs lots of energy as an input, which eventually gets passed on to you as a consumer. Also, don't forget that everything's made out of plastic, and is another big factor that also comes from oil. So expect this to also have a huge effect moving forward if global energy prices don't come down. Unfortunately, as you can see, the current trend is heading upwards, and oil might break $100 a barrel for the first time in a very long time. And for a country like the UK, there's very little we can do about this, as we don't have the same level of energy security as a country like the US does, as an example. Now, on that topic of the global market, is the UK really doing badly when we look at the bigger picture, or are we all being just way too cynical? If we compare to the Eurozone and the US, here's where things stack up. From a European perspective, we're definitely towards the higher end and way above the average for the Euro area and the European Union currently, which sits at 5.2% and 6.1% respectively. There are definitely some countries worse off, but there are smaller populations and some big outliers like Turkey having a very terrible time at the moment. Great for holidaymakers, but pretty terrible if you live and work there. The US puts everyone to shame with a current inflation rate of under 4%, now at 3.67%. Still high by everyone's standards, with targets around 2%, but heading in a much better direction. So what's to come next? Well, the government have said that getting inflation under control is a top priority, and the Chancellor is taking credit for today's figures, saying that whatever they're doing is working.
Inflation is a source of instability, and if we want to have prosperity, if we want to grow the economy, if we want to reduce the risk of recession, we have to support the Bank of England in the difficult decisions that they take.
However, if the price of energy remains to rise as we head into the winter period, then this is definitely going to work its way into the numbers and cause more pain for millions of households at the supermarket and to heat their homes on already very stretched budgets. Take a look at here at how the price of fuel, energy and housing costs have contributed to the inflation number. See how energy is in these bright blue bars and has really pushed the numbers up. If we see that spike again, expect another round of pain, and then the only reaction the Bank of England can really do is to keep interest rates higher for a longer amount of time, which will then feed through to those other costs like rent and housing. And don't forget about the mortgage time bomb that we spoke about earlier. The worst is definitely yet to come there and will probably coincide with the next general election, but watch this space and let's see what happens. It's also worth noting that recent pay rises that a lot of people may have had to keep up with inflation will also put a lot of pressure on the numbers as we move forward, especially the recent deals brokered by unions and the government. And as a service-driven economy like the UK overwhelmingly is, we do run the risk that inflation remains very sticky and the prices we pay for those services stay high because of the effect of those pay rises. It's a very careful balancing act that the government, the Bank of England and businesses have to play to get these things right, otherwise we do risk getting ourselves stuck into a recession, which so far we've managed to hold off. Now, there's always loads more to cover. I tried to just pick a few bits from today's report to focus on, but do let me know below in the comments if there's anything I've missed, or if you'd like me to do more videos like this in the future. I'll see you in the next one. Happy investing.